a question. Over here, Todd.
Yes, I'm Todd Heller. I'm a grain producer from Greenfield, Indiana, and Mr. Bauer alluded to the fact that this market has changed completely in the last year. And, you know, as I sit down every morning and turn my computer on, I see that I could go to the dollar index and the crude oil market and almost tell you what the grain market's doing in that sense. Have we moved from a situation where fundamentals, the supply-demand fundamentals, is that ever going to come back into play in this market, or are we moving this entire commodities market to a position where one thing's going to be impacted by a totally different commodity?
Okay, let's go to Mike Hogan with that. Mike is with Stuart Peterson, and then we're going to come to you, Alan.
I think for what we're in this day and age, I think that is a very valid point that Jim does make. You do have to look at a lot of the outside markets. As far as the dollar index is concerned, my belief personally is that it does have weight when it's at an extreme. In other words, when we saw the dollar index up at the 120 mark several years ago in the late 90s, early 2000s, guess what? At that point in time, grain prices were literally in the gutter at that time. We're seeing the inverse of that happening right now, so therefore grain prices are boosted. So from that standpoint, if we ever move back to more of an equilibrium point, say 100-point par value, maybe 90 to 110, I don't think it has nearly the amount of impact that it does at the extreme levels at this point.
Okay, Alan?
Yeah, basically, the one thing you have to remember is that the price movement that we've seen in crude oil and in the grains has been a much larger percentage move than would be explained by the dollar index movement. Okay, they're correlated. They're moving at a 0.95 core R squared, so they're going the same direction, or actually inverted. The dollar's going down, the others are going up. But the point I'm trying to make is that some of the movement that we've had in the grains and even in the livestock is an exaggerated response to the dollar because it's being used as a proxy. Stock market, same thing. It's a proxy for the economy right now. It's simple to watch the stock market go up and down and say, okay, this is a composite of the what's going on with unemployment and GDP and everything else. But we're going to have to continue to follow the dollar in the short run because that's the emphasis. But I almost guarantee you that correlation is going to break down.
Okay. Alan, by the way, is president of Brugler Marketing and Management. Bill, did you have a comment on this?
Yeah, I do.
Okay.
First of all, the dollar has moved, and typically that would make our grains cheaper on the export market, but these funds have run the market so disproportionately up that you can't sell wheat right now in the export market. You can't even, well, the only way we're getting rid of it is to give it away. My point being is that the funds are the real root of the question at hand, is what's driving the markets, and is it just correlated to the dollar? No, it's correlated to the imbalance that we have between the ability of the funds to put on positions that are exempt from any limitations, while they're still limiting the amount of grain that our good friends at Cargill can deliver to the exchange. And until we get balance back, where we have the commercial industry balancing the speculative interest, we're going to have an imbalanced market. And it's going to do things that we can't explain. It doesn't correlate to anything other than the big power at hand.
Okay, Richard, you are nodding your head there.
Well, those who have heard me speak before, it's been part of my dog and pony show for the last 2 years, because when you take and I'll show the charts in my presentation today, when you take a look at the amount of money in the GSCI fund alone, and combine that with the other two major funds, at the top of the market, our estimate was they were long about 2.4 billion bushels of corn in three funds in summer of 2008. And when you've got that one large fund that controls over 50% of the index fund money with well over, I mean, we're talking huge, huge amounts of money. 70% is to be invested in crude oil. All you gotta do is get a prospectus on it. 13.9% is the grain market, and they got to balance on a monthly basis. I mean, it's easy to figure the math why this market's moving the way it is. As the money flows into those funds and crude oil goes up, they have to buy more corn and beans to keep the fund balanced. And as we said, it's a double-edged sword. Then when crude oil turns down, they have to sell corn, soybeans, and wheat. And none of the growers' organizations want to do anything about it because it's a long-only fund and they only buy. And the only industry against this right now really that has been fighting in Washington is the American Feed Industry Association.
Yep.
Because it's putting the feed industry and the livestock industry out of business. And as Bill said, until you get some balance in here to where everybody can make some money, we're on a freight train about ready to run into a brick wall.